All right. So again, good afternoon, everyone. Thanks for joining us for the third quarter market review. Noon, October 20th. I'm Brian Reese, and I'm joined, of course, by my partners, Scott Jones and Ryan Ironman. So today we're going to walk you through the third quarter market review, where we've been, give you a little guidance going forward as we're hard to believe, but we'll be closing out the year of 2025 here before we know it. So before we get going too far, though, I do want to make sure everyone is aware. Hopefully you're aware that, by signing up today, we want to do something a little different, a little special. So we've got a $15 Panera gift card that we're going to be sending out to everyone that's on the call. Those are going to go out by email. So just as long as you stick with us for the whole call, however, 25, 30 minutes or so, we'll get that out to you pretty quickly. So again, thanks for joining us. For anyone that's new, just so you know that we are a team of financial advisors here in Crocker Park. You've got the three CFPs on the team, but we're supported by a couple of administrative support people. Tim Ironman runs the show here. Crocker Park, all of our contact information is here. So if you have questions about what we're talking about today, or overall questions, or want to ask us anything, feel free to shoot us an email or give us a call. If one of us is not here, if we're in a meeting, you're going to get Julianne or Renee or Davia to help you out, or direct it to us. So all good stuff going on here at Crocker. Reminder of the overview of services. So one of the things that's not on here is most of our clients, retail clients, we've got a client service plan that we're following. But along those lines, we've got for 401k plans and plan sponsors, we've got group meetings, employee one-on-one meetings, on-site education, a lot of things that are outside of what you may think of normally, from just how to invest money. But we've got a lot of other tools at our fingertips through financial planning. And this time of year, now that we're in open enrollment, Medicare open enrollment, so we've got licensed Medicare professionals that we can lean on for our clients. Social Security planning, and again, we've got experts that we lean on if it's outside of our area of expertise. So a lot of other tools that are available to clients. Just let us know what you need beyond the normal scope of things, and we'll get you off on the right foot. The idea today is we'll go through the market update, some key themes, stock market outlook by Ryan, bond market outlook by Scott. Reminder on diversification, because ultimately right now that is as important as ever to make sure you're properly diversified. And then Scott will wrap it up with available resources and our contact information once again, if you didn't already get that. So with that, we're gonna jump right in. So I'll give a little commentary before I look at or talk about any of the numbers. But when we look back at the third quarter, the U.S. stock market has been very resilient, has had really strong performance. Third quarter, we hit new record highs again. The S&P closed for the first time ever above 6,600. So the bull market continues. Corporate profits, corporate earnings have held up relatively well. Most of the continued rally has still been by the Magnificent Seven, or at least a part of the Mag Seven, but them in addition to the AI hyperscalers and the technology boom, as well as the thought on where future interest rates are going to go. So if we're expecting a couple more cuts like we just had recently, that typically is a good sign for the stock market. CapEx spending is still strong. Consumer spending still strong. Earnings better than what a lot of people had expected. Inflation and tariffs are still present, but not really overwhelming us or overwhelming the system just yet. And picture, we still feel like the bull market has room to run based on some of these things. So third quarter returns. So if we look at the Dow top line with the Dow Jones Industrial Average, Q3 we were up about 5.22%, which puts the return over the last 12 months at close to 10%. S&P 500 index up close to 8% on the quarter, which double that puts us up about 16% over the last 12 months. And the NASDAQ has just kept on rolling. As I mentioned, AI and the tech firms that are running with this, but quarter up 11.25%. And again, more than double that, close to 25% over the last 12 months. So again, very, very strong performance within the NASDAQ. And then the MSCI EFA index. So this is the international index that most people use and look at, up about 5% on the quarter. But over the last 12 months, that puts the index up 15.5%. So finally, some good performance out of our um, international firms, international stocks. As far as the fixed income side of it goes, 2-year treasury at 3.61, 10-year treasury at 4.15. 30-year mortgage has finally started to come back down. You can see it was higher at 6.8%, down to 6.36. Housing prices are at all-time highs, near all-time highs. Uh, Interest rates have been cut once recently. Scott will talk a little bit more about it, but a couple more probably coming. So that should help the 30-year mortgage, should help knock that down some, which will in turn help make homes more affordable. And then the last one, I suppose we should have this one highlighted in gold or something to show, but the third quarter return on gold was 17%, and then the 12-month return on gold 45%. One thing I'll add there is we don't have too many clients that are buying bars of gold at this point. Um, More so using a gold ETF, exchange traded fund. If they're invested in gold, that's the pretty typical way of doing it. But again, great returns. And I know, this is the end of the third quarter number with gold at 3,800, but gold is, without turning around and look at my TV, at least 4,000, 4,100, somewhere in that range at this point. So again, really strong performance. And guys, I think maybe at some point on something like this, we should add Bitcoin in there too, just to show what the Bitcoin performance has been. Even though it's down, I mean, it's down considerably now, but it's been an interesting run with Bitcoin. And then the sector snapshot. And remember, guys, we get this information from some of this information from our partners at Raymond James, whether it's our chief investment officer or chief economist, but they're helping to put together some of these reports and some of these numbers for us. But the overweight sectors: healthcare, information technology, industrials. Remember, a lot of money is getting pumped into the AI world, and building out these gigantic AI super centers. So there's a lot of industrial money, a lot of money going towards industrials within that world alone, let alone other things. But equal weight communication services, financials, consumer discretionary, staples, utilities, and then underweight energy, real estate, and materials. Okay, so and I mentioned some of this, but this is record breaking. These are the positive records that have been broken in the third quarter. And the size of the U.S. economy, by far the largest in the world, close to $30 trillion. Uh, Estimated GDP growth, 3.9%. So, that's one of those things that as the economy continues to grow and GDP continues to grow, all drivers, especially the GDP number, drivers of the economy, and hence driving some of the stock market as well. The the other records on here, though, I think are really interesting. It's the record household net worth, close to it's I don't think it's hit 180 trillion, but it's 170, 175, 177 anyway. So that's a record. Now, along those lines, consumer spending is also at a record high. So is that good for the consumer? Is that good for the market? But nonetheless, net worth all-time high, consumer spending record high, corporate profits still strong. We're getting back into the earnings season. We'll see. The expectation is strong profits will continue. And here at Raymond James, we feel the same way. That's our expectation. Now, as we look forward, maybe it's a little bit more muted into the fourth quarter, into the first quarter of next year, but still feel optimistic about earnings and the overall market. And then the less appealing records. So you've got to be living under a rock if you haven't been hearing on a daily basis what the national debt level is. Maybe not necessarily what it is, which is close to 38 trillion, but the simple fact that it continues to grow, and that is a continuing problem that's growing as well. But that's uh, record highs. Affordability of goods is, I think I mentioned record high housing and car costs. So the affordability of goods coming down, right? You're spending more money on these things that you used to not spend nearly as much. Um, Tariffs are a part of, potentially, or probably a part of that as well. Now it's transitory is a bad word. That was a bad word for a while, but here at Raymond James, that's the thought with the impact of tariffs. It's transitory pricing, short-term price increases. Um, but nonetheless, affordability of goods down. Wealth disparity continues to grow. So the top 2% own or account for 30% of the net worth, while the bottom 50% own or account for 2% of the net worth. So top 2%, 30%, bottom 50%, 2%. And that you can see with this, the disparity continues to grow. And then the policy uncertainty index. I think that the number one thing that we think about here is where do we sit on um, tariffs, and then overall geopolitical risk, and how we're working with our partners all around the world. Um, I do think, slower, we're still optimistic, as I was saying, but slower global growth, and there is some dependence on interest rate cuts. So I think those are just some things that we keep in the back of our mind, knowing that the market isn't always going to go up, isn't always going to be setting new highs, that there will be some periods of pullbacks, and these are some of the things that we're looking at. And then job creation is cooling down as well. So overall, I would say on where we've been in the third quarter, great year, great quarter. Still feel very, very good about where we're headed. Just knowing that in the back of our minds there are a couple of things that we're keeping our eye on, and reminded why diversification works and how it works, especially when international investments are doing their part for us, or starting to do their part for us. So that's all helpful. All right, so I'm gonna let Ryan talk a little bit more about the market, a little bit more insight, and then I think probably the most interesting slide to me for Ryan's section is exactly this: how have the markets performed during and after a government shutdown?
Yeah, thanks, Brian. So, yeah, the answer to that question is during government shutdowns, the market has actually done surprisingly well. So if you look at that chart over on the left side of the screen, that shows the average performance of the S&P 500 during government shutdowns is 0.7%. And that goes back all the way to 1976. So there have been about 20 or 20 exactly government shutdowns since then. And that's the average during the shutdown. But it also shows 3 months after a government shutdown, the average return of the S&P is 2.6%. And then 1 year after, it's all the way up to 12.4%. So if you take a look at the chart over on the right, that's showing all the shutdowns going back all the way to that date, September 30th, 1976. The longest shutdown we've seen in that time was 34 days. But if you take a look on the three columns over to the right side of the screen, you can see that the S&P performance has not done that poorly during the shutdowns. So, the lowest number we're seeing there in the third column from the right is negative 3.9%. If you look 3 months following the next column over, one of the lowest numbers we're seeing there is negative 8%. And then 12 months following is the last column on the right there. And, most of those numbers look pretty good. And the lowest one coming in at negative 6%. So overall, the market performance tends to do pretty well during shutdowns, surprisingly. So this is the S&P 500 performance going back to 1980. And the S&P 500, just to refresh your memory, is the 500 largest companies in the US stock market. So year to date, if you look at that final column over on the right, we're up 14% as of the end of September. And you can see that the low point for the year is that red dot at negative 19%. That was back when Trump announced the tariffs in April. So every gray bar is where the market finished for the year, and every red dot below that is the low point for the year. So this is really a testament to long-term investing. As you can see, 75% of the time the market finishes positive, despite there being a pretty major yearly sell-off. So main thing being, as long as you stay invested, it's usually to your benefit during some of these downturns. So moving on to just looking at this past summer for US stocks, this is another record. We've seen the second best summer for US stocks going back all the way to 1950. So the chart on the left shows the year-to-date 2025 returns, and we've actually seen international stocks do very well this year, followed by US stocks at 14.8%. But then if you look at just the summer in that gray box there, you can see that US stocks returned 20.8% from May 1st through September 30th, followed by international at 12. And then the chart on the right is just showing that it's ranking the best summers since 1950. 2009 was the best at 22.3%, followed by this year, 2025, at 20.8%. And then our outlook for the rest of the year. Our 12-month target for the S&P 500 is 6,900. we're already at 6,700. So valuations are pretty high, but so we would say that number is going to have to come mostly from earnings growth over the next 12 months. But if you look in the middle there, a couple of the reasons why we are optimistic. We expect GDP to grow throughout 2026, largely due to some stimulus from the Big Beautiful Bill and tax cuts, getting more clarity on the tariff situation throughout the year, and then some shareholder-friendly activities we've seen. Like Brian mentioned, CapEx has been very strong. Consumer spending has been very strong as well. And then we're expecting the Fed to keep cutting rates. So we're expecting 2 more by the end of this year, and then at least 1 more in 2026. So with that, I will pass it off to Scott, and he will talk about the fixed income market.
Great, thanks, Ryan. Thanks for joining, everybody. So I'm just going to go through a quick overview of fixed income market, give you an outlook. So this chart is similar to what Ryan shared on the S&P 500. It's just looking at the U.S. aggregate bond index and the yearly returns over the last 49 years. So you can see year to date on the far right, we're up about 6%. So it's pretty kind of a back to normal, what we would expect from our fixed income investments. Still, believe it or not, we're still coming off of the 2020 to 2022 decline, and we're actually not back up to the high yet. We're approaching about 5 years here, so it's been a record recovery time frame in fixed income. Never seen that before, but moving forward, I think we've been talking a lot about rates and what the Fed might do. We kind of talk about they have a dual mandate. They're looking at inflation, and then they're looking at employment numbers. Unemployment has started to creep up a little bit, although I would say it's still historically low from that standpoint. So with that, from Raymond James viewpoint, we think before year end we're expecting 2 rate cuts and then potentially 1 in 2026. So our viewpoint is that we call it the short end. This would probably impact money market rates, CD rates. You'll start to see those come down. But from there, if you look at the kind of the forecast that we have in the light blue here, we think that's going to stay pretty range bound, pretty consistent, which should lead to pretty steady normal returns in fixed income moving forward. So it's kind of more of the same. We'll see what the big question here really is, who will be the Fed chair. We probably will get more Jerome Powell. This is somebody that's going to be changing, and we'll probably know towards the end of this year into next year who will be in replacing the current Fed chair. So that person may have a different direction than the current trajectory. So for right now, we're expecting a couple more cuts, 1 in 2026, and you would see that moderately help fixed income returns. Although I think we would say you'll probably see fairly steady, normalized fixed income bond returns moving forward from here. So kind of diversification. We've talked a lot about different asset classes. Brian got into at the beginning. We have seen international. This is a chart here that kind of shows different investment returns over the years. You might find a lot of these in a 401k plan that you can choose to invest in. So we talk about diversification, kind of spreading your money across all different types of investments based on your risk tolerance and your time horizon till when you would need the funds or in retirement. But over on the far right here, these are the year to date through the end of September. The returns, the emerging market purple box is actually international, as well as the developed market international equities, the gray box. So those have been the two best performing categories year to date. In the third quarter, though, US actually did outperform international, but still trailing in 2025. That's been a pretty big change. If you look over on the far left over here, these are the average annual returns from 2010 to 2024. And you can see the developed market gray and the emerging market purple. Those have really lagged the S&P 500, which is the green box here, 13.9% every year on average. But we'll have to see kind of where that goes. Some of that has to do with tariff talk that Brian talked about, but also the dollar has depreciated versus foreign currencies. Some of that may be strategic to make U.S. goods more economical, more attractive, but we'll kind of have to see how that plays out. As a firm, we're not really deviating from our overweight U.S. position versus international, but it's important overall to diversify, and we can help you do that. Obviously, if you're a retail individual client or an employee at a 401k that we are involved with, we can help you make sure that you're properly diversified. The other thing I thought this chart was kind of neat because I think it's important as we move forward. So this is Roger Federer, who's obviously a well-known tennis player. My wife and I are trying to get our youngest daughter, who's now 5, into tennis. So I probably learned more about tennis in the last year than I would say I probably have ever learned, but it's a good sport. And so this here is just kind of showing you his overall win rate was 82%. He won 82% of his matches. But if you look at the actual points, he only won 54% of the points in the match. And it's kind of eerily compares to the stock market. If you look at the S&P 500, since 1950, it's returned almost 425,000%. Its annualized total return has been 11.7% a year. And if you look at any rolling 3-year period, so from 1 year to the end of the 3rd year, it's been positive 85% of the time. But each day, the market is only positive 53% every day. We talked about, Ryan showed a chart that on an annual basis, the S&P 500 typically has a positive gain about 75% of the time. But if you drill down to day by day, each day, there's about a 53% chance that the stock market will finish up. So I think it's very important to kind of look at a longer term. Obviously, if you're in a retirement plan, a 401k, you can't be looking at things on a day-to-day basis because essentially you're, just providing positive gains above half the time. So, if we look at things over a much longer time frame, we have patience, we're persistent, we're prepared, we can make good investment decisions, and that's what we're here to help with. So hopefully everybody found this helpful. Just kind of going into, again, some other ways we help. Whether you're in a 401k plan, there's what are called target date mutual funds, which are based on a retirement year. We have risk-based portfolios. We also have, those risk-based portfolios when we work with our retail investors. And so that's a much more professionally managed. Green is good, right? Red is risky, building your own. If you're not comfortable with this kind of thing, making sure you're making right decisions. So we have questionnaires that we take employees through. We also have a similar questionnaire on the individual side, and we help make sure you're in the appropriate portfolio for you based on your risk preference. And those portfolios are made up of multiple asset classes, investment types that we talked about. So with that, we're up on 12:30. We have these calls every quarter. We do record them. So if there's something you want to refer back to, we put them out on YouTube usually within a day or two. And you can watch the replay, or if you want to send the replay to a friend or family member you think might benefit from it, feel free to do so. So here's our contact information one more time. Some of the services we offer is helping provide investment advice, retirement planning. We can meet individually over Zoom or in person. We provide market updates, newsletters, things of that nature if you want to sign up for those. So I appreciate everybody attending. We'll look out for our next call to be into 2026. So we'll probably mid-January be sending out invitations for that, and keep an eye on for those. So with that, I don't know if anybody else had any, Ryan, Brian, any closing comments?
No, just reiterate what you said, Scott. Thanks everybody for joining. We'll talk to you again in the new year, and enjoy the holidays. Enjoy time with your family and friends, and we'll talk soon.